Welcome to the deep dive. Ever feel like you're just drowning in information? Especially, when it comes to your money, your future.
Oh, absolutely.
Article after article, expert after expert.
Uh,
It's a lot. You almost feel like you need a secret map just to know where to even start looking.
it's genuinely overwhelming sometimes. The sheer number of investment choices can be paralyzing, can it? Makes it really hard to see a clear path forward.
Exactly.
And that's precisely why today we're doing a deep dive into navigating the world of global investing. Specifically, we're going to compare the top global fund picks for 2025 from two of the biggest names in the UK investment scene, AJ Bell and Fidelity.
Right. So our mission here is really to sort of cut through all that noise. We want to pull out the most important insights and give you a shortcut, really, to understanding how these global funds could potentially make your money work harder for you.
Yeah, the aim is for you to walk away feeling properly informed, maybe even a little surprised by, what these platforms are actually recommending.
And it matters, doesn't it? I mean, the world's so connected now. Global investing just seems like a really smart way to spread your risk, build wealth over time. Good for ISAs, pensions.
Absolutely. They're very versatile. But like you said, there are literally thousands of funds out there. So where do you begin? That's where these expert lists from Aegis Bell and Fidelity come in handy. They do a lot of the legwork, filtering down the options to, a more manageable starting point.
Okay, so let's nail down the basics first. For anyone listening, maybe they're new to this or just need a quick reminder, when we say global fund, what exactly are we talking about?
Okay, yeah, good question. Think of it like a big pot of money. Lots of people put their money in together.
Right.
And then a professional manager takes that whole pot and invests it in companies all over the world. So instead of you trying to pick, say, a tech stock in the US or maybe a healthcare company in Europe.
You just buy a piece of the whole pot.
Exactly. You buy a unit, which is basically a small slice of this much bigger professionally run portfolio. You instantly own a tiny bit of lots of different companies.
Ah. So it's like getting a mini portfolio of global companies without having to do all the stock picking yourself.
Yeah.
That sounds, pretty efficient for diversification.
It is, yeah. That's the main draw, really built-in diversification. Your money gets spread across hundreds, maybe even thousands of companies, different countries, different industries. So if one market or one sector takes a hit, it doesn't necessarily drag your whole investment down. It acts like a cushion.
And they're flexible too, right? Not just stuck in one place. They can invest in like the big U.S. giants, but also maybe emerging markets, India, Brazil, across different sectors too, like tech, healthcare, finance.
That flexibility is crucial. Yeah, exactly. Your money isn't tied to the fate of just one economy or one type of industry, which, makes them a pretty smart choice for long-term growth. You get that instant diversification, professional management, often for one single investment. It's quite compelling.
That diversification part really sounds key. Okay, but then the next question is, who do you trust? There are so many platforms. Why are we focusing specifically on AJ Bell and Fidelity today? What makes them stand out?
Well, they're both really big players in the UK. AJ Bell, they started back in '95, known for being user-friendly. They have their favorite funds list.
Yeah.
And then there's Fidelity, a massive global name, huge research power, with their well-known Select 50 lists.
Okay.
Both are consistently seen as, highly trusted platforms, good research, good customer support generally.
So these lists, the favorite funds or Select 50, they're not just random picks then. How do they actually choose them? You said it's rigorous?
Yeah, it's definitely not random. They have their own in-house teams, analysts who do deep dives into these funds. They're looking beyond just, what did well last year. They scrutinize the manager's whole approach, their philosophy, the team's experience, how they manage risk. Is their strategy consistent over time? So yeah, getting onto one of these lists is generally seen as a stamp of quality. It means the funds pass some pretty tough checks.
Okay.
But, and this is important, they are just recommendations, guides, not personal advice tailored to your specific situation. Always remember that.
Got it. That makes sense. Okay, let's dig into AJ Bell's 2025 picks then. What's their general philosophy? What are they aiming for with their favorite funds list?
AJ Bell tends to lean towards experienced managers who have really clear, repeatable ways of investing. They seem to value simplicity, reliability, making their list suitable for quite a broad range of people looking for maybe steadier growth.
And the big name that always seems to pop up on their list is Fundsmith Equity. Terry Smith. What's the deal with his strategy? It sounds almost simple.
It does sound simple, but the discipline is key. Fundsmith holds a pretty focused portfolio, maybe 20, 30 stocks, of really high-quality global companies. Think Microsoft, L'Oreal, names like that. Terry Smith's mantra is famously, buy great companies, don't overpay, and then do nothing. Basically, hold for the long term. What's interesting is what he avoids complex stuff like banks, airlines. He sticks to businesses he feels he can really understand.
Right, so very focused, quality-driven. Does AJ Bell offer other flavors too, maybe for people interested in, say, ethical investing?
Yes, they often do. Their list usually includes funds with a strong ethical or sustainable slant, appealing to investors who want their money to, make a positive difference as well as grow.
And what about passive investing? For people who just want broad exposure at a low cost?
Yep. They usually feature a global index tracker fund, sometimes called a global all-cap tracker, meaning it covers big, medium, and smaller companies worldwide.
Ah, okay.
It just aims to mirror a global stock market index, so you get really wide diversification, but with very low fees because there isn't an active manager making constant decisions. Great for cost-conscious investors.
So AJ Bell gives you this mix: focused active quality, ethical options, and a solid low-cost tracker. Sounds like a good toolkit, especially if you want clarity and maybe a set-and-forget kind of approach.
Exactly. It seems designed for that purpose. Clear choices, reliability, accessible for many investors.
Okay, that provides a really clear picture of AJ Bell. Now, let's switch gears to Fidelity. Is their approach similar, or are we looking at something quite different with their Select 50 list?
It's generally a bit different. Fidelity Select 50 often showcases funds with perhaps more unique or diverse strategies. It feels geared towards investors who might want a broader range of active management styles and maybe are willing to pay a bit more for that expertise. Their list really reflects a strong belief in skilled managers finding opportunities in different ways, embracing diverse investment styles.
Can you give us an example, one of those more innovative funds from their list?
Sure. A fund often highlighted is the Wathbone Global Opportunities Fund. Now, this one isn't just about buying established quality like Fundsmith. It's actively hunting for overlooked, innovative companies around the world.
Ah,
It tends to be more diversified than Fundsmith, maybe holding 50 to 60 companies. The focus is really on trying to spot those future winners before everyone else does.
that sounds quite different, yeah. More like treasure hunting. What about funds with more flexibility?
Yeah, they often feature funds like, say, Fidelity Global Special Situations. This type of fund gives the manager a lot of freedom to invest pretty much anywhere they see the best opportunities globally, often targeting companies going through some kind of big positive change, trying to capitalize on unique situations.
Interesting. And do they cover value investing too? Maybe quickly explain growth versus value for our listeners who aren't familiar and why that difference matters.
Yes, they definitely include value funds. You might see a Global Value Leaders Fund, for example. These funds hunt for solid, established companies that the manager believes are trading for less than they're actually worth.
Okay.
So, to simplify, growth investing bets on companies expected to grow their earnings rapidly, often tech or newer industries, even if they look expensive now based on future potential. Value investing looks for solid, maybe less glamorous, companies that seem cheap compared to their current assets or earnings, perhaps due to temporary problems or just being out of favor.
Right.
And that distinction matters because different market conditions tend to favor one style over the other. So having both in a portfolio can potentially help smooth out returns over time.
So Fidelity's list definitely seems to embrace a wider range of active strategies, growth, value, special situations. It feels more eclectic, maybe.
Yeah.
Compared to AJ Bell's focus.
Eclectic is a good word. Yes, it's about offering different ways to tap into global growth, relying on various skilled managers with distinct approaches.
Okay. Fascinating. So now for the head-to-head. AJ Bell versus Fidelity. We've looked at them individually. What are the core similarities, but more importantly, the key differences listeners should really grasp?
Well, fundamentally, both platforms clearly believe in active management, the idea that skilled managers can potentially beat the market. And obviously, both lists focus on globally diversified funds. That's a given.
But the flavor is different, isn't it? It feels like more than just two lists. It's almost two different underlying philosophies.
I think that's fair, yeah. AJ Bell, as we said, tends towards those focused quality growth funds like Fundsmith. And importantly, they include that strong low-cost tracker option. Their emphasis seems to be on simplicity, reliability, consistency.
Disciplined approach.
Exactly. Whereas Fidelity leans towards more diversified active funds, covering a broader range of styles value, special situations, innovative growth. Their list is all active management.
No passive option highlighted in the Select 50 typically.
Not usually in the Select 50 itself, no. Their focus there is purely on showcasing active manager skill across different approaches. It's less about buy great and hold, and maybe more about actively find great, sometimes hidden, opportunities.
So the impact is that while both offer global diversification, how they achieve it, the regions they might favor, the types of companies can be quite different.
Yeah.
Which, of course, affects performance depending on what the market's doing.
Precisely.
It really seems to boil down to, do you prefer that concentrated quality approach, which seems to be A.J. Bell's strength, or the more diversified multi-strategy opportunity seeking that Fidelity champions?
That's a great way to put it. Your choice really depends on your own investment personality, your goals, how comfortable you are with different kinds of risk. Are you backing the proven champions or the dynamic explorers?
This comparison really helps clarify things. Okay, let's get practical. Someone's listening, they're thinking about taking the plunge into global funds. What are the absolute crucial things they need to consider before picking one?
Okay, number one, without a doubt, fees. Look for the OCF, the ongoing charges figure. It tells you the total annual cost of owning the fund. Even seemingly small differences in fees add up massively over the long term. They eat directly into your returns.
Yeah, that compounding effect works both ways, doesn't it?
Yeah.
And resist just picking last year's winner.
Absolutely. Classic mistake. Don't chase past performance. Instead, try to find a fund whose strategy makes sense to you, something that feels right for the long term and aligns with your goals.
Now, how do you figure that out?
Read the fund's fact sheet. Seriously, take 10 minutes. Understand its style, growth, value, quality. Look at its top 10 holdings. Do they make sense to you? Does it feel like something you're comfortable owning?
And remember, it's a long game, right?
Yeah.
Not for quick profits.
Definitely. Global equity investing should really be for 5 years plus, ideally longer. Markets go up and down. You need time to ride that out. And link that to your risk tolerance. How much volatility can you stomach? Do you prefer a smoother ride? Or are you okay with bigger swings for potentially higher growth?
Good points. What about putting a portfolio together? Do you just pick one fund?
You don't have to now. Many people actually blend approaches, maybe use a low-cost global tracker, like the one A.J. Bell might suggest, as your core holding.
Right, for broad market exposure.
Exactly. And then maybe add a more specialist active fund, perhaps from Fidelity's list, to target a specific style or opportunity you believe in. You can tailor it. The most important thing, honestly, is just getting started. Don't let perfect be the enemy of good.
Sound advice. Okay, looking ahead to 2025, any big market themes or watch points people should be aware of? Things that might affect how these global funds perform?
Well, the big ones are still inflation and interest rates. What central banks do next will definitely ripple through global markets and impact fund performance. Keep an eye on those macro trends.
And what about sectors? U.S. tech has been dominant for ages. Could that change?
It's possible. U.S. tech is still huge, obviously, but you might see shifts. Other regions, other sectors, maybe healthcare or financials or even energy could gain momentum, perhaps look more attractive from a value perspective. Diversification helps here.
Politics, too. Elections and things.
Yeah, political events always create noise, maybe some short-term wobbles. But again, that's where the global diversification of these funds really helps. They're built to absorb shocks from specific countries or events over the long run.
And the growth versus value styles we talked about.
That's a key one. Growth has had a fantastic run. But if economic conditions change, maybe rates stay higher for longer, value investing could definitely make a comeback. And remember, A.J. Bell and Fidelity's lists often have different biases here.
So mixing styles could be beneficial.
It could certainly help balance your portfolio against those shifts. But the main takeaway is, stay informed, yes, but don't try to time the market perfectly. Focus on your long-term plan. Stick with diversification. That's how these funds help you navigate the inevitable uncertainty.
Okay, so pulling all this together, how does someone listening decide which platform's approach, A.J. Bell or Fidelity, might be a better fit for them?
Well, if you value simplicity, reliability, maybe you're just starting out or you're a bit more cautious, A.J. Bell's focus on quality growth and their clear, low-cost tracker option could be a really good fit. It's straightforward.
And Fidelity, who might lean towards them?
Fidelity, with its broader range of active styles and potentially more niche funds, might appeal more if you want greater choice. Perhaps you're more engaged with investing and you're comfortable paying a bit more for that specialized management expertise.
So it really isn't a case of one being definitively better than the other.
Absolutely not. There's no single best answer. It really depends on your individual needs, your comfort level, your own beliefs about investing.
And you mentioned blending.
Mm-hmm.
Could someone use both?
Definitely. That can be a very sensible approach. You could use, say, an AJ Bell tracker as your core, cheap, diversified base, and then maybe add a specific Fidelity active fund on top for a particular strategy or exposure you like. You get the best of both worlds, potentially.
Right.
The key, really, is feeling informed enough to make a choice you feel confident about.
And that confidence, that understanding, is exactly what we aim for here on the Deep Dives. Knowing your options, understanding the thinking behind them. That's a massive step towards feeling empowered with your finances, isn't it?
It truly is. It's about giving you the tools and the clarity to make those important decisions for your own future.
So as you think about your own investment path after hearing all this, consider what kind of investor you really are, or perhaps want to become. Are you drawn more to that disciplined, focused, quality approach we saw with H.A. Bell? Or does the dynamic, opportunity-seeking, multi-style approach of Fidelity resonate more? And maybe the most interesting question is, how could blending these different philosophies actually shape your financial future in the years to come?